So I got an undergraduate degree in accounting, and then actually my goal was to become a CA. So I actually was working for a company that is, now it's become Ernst & Young. You've heard of it, perhaps? Okay. Back then it was called Ernst & Young, Ernst & Winnie Murray. So I worked as an auditor for a while, and I decided actually to come back to India at that point. And I went to the Delhi School of Economics, and I did an MCOM. And then I was working for a company that's maybe not so famous now, but back then it was very well known. It's called Escorts Limited. You've heard of it? In Faridabad. So I worked in their central accounts and finance for a little bit. To be honest, I didn't really enjoy that very much. So after about a year or so, my father, who was in the Indian Foreign Service, was posted in Belgrade, in Serbia. So I called him up and I said, listen, I don't think I like this, maybe I can come to Serbia. And so my father said, okay, that's fine, there's only one problem. I said, what? They don't speak English in Serbia. I said, okay, well, let me come anyway, and we'll figure things out. Well, as it turned out, I went there, I spent a little bit of time there, I learned Serbian, and I ended up going to the University of Scranton for my MBA in finance. I did that, and my professors over there encouraged me to consider doing a PhD. And so one of the things in life you're going to learn is that you may think your professors are very harsh and very hard on you, but if you listen to them carefully, they'll usually give you good advice. So I listened to my professor, and I went to Central University, did a PhD in finance. And then the same professor said, why don't you come back to the University of Scranton to teach? So I went back to the University of Scranton in 1989 as an assistant professor of finance. And so I've been there since '89, but over time I became an associate professor and then the director of the MBA program, and more recently in August, my dean actually asked me if I would become the interim associate dean. So that's actually the position that I'm at right now. So again, just a little bit of history, and what I'd like to do now is talk a little bit about risk management using derivatives. How many of you have had a class with derivatives? Not some of you have? Okay. So I know the reason I ask is I don't want to bore you with stuff that you've already had. Hopefully this will be of some interest to you. And what I've tried to do is try and tailor it to the Indian market. So there are some overlap. There are differences mainly in the way the derivatives are regulated. So let me start with a forward. Oh, you. All right. So have you all heard of Warren Buffett? Yeah, pretty well-known investor. So this is Warren Buffett's view on derivatives. I don't know if you've heard of this, but he's not a big fan of derivatives. All right. So his view is, these are his words, that derivatives are financial weapons of mass destruction. And what's interesting is, I think tomorrow I might be actually doing a presentation on the financial crisis. That is true depending on how you use derivatives. Okay? And it's interesting that in India, as opposed to in the US, the regulatory structure almost forces people to use derivatives to hedge. What Warren Buffett was talking about over there is when you use derivatives to speculate, they can become weapons of mass destruction. Okay, so he's not wrong, but it depends on the use. All right. So my goal over here is not to show you about the speculative aspect, but rather how you can actually use it to manage risk. All right. So the derivatives that are traded in India. Again, I'm going to just focus on financial derivatives. So we've got options, calls and puts, futures and forwards, swaps, and then most recently in 2011, in December, they actually started trading credit default swaps in India. So I hope we have time to go through all of them. So what I'd like to do is to actually go through, define them all individually later on, but give you an idea of the overall structure of derivative markets right now. So this is what we have in terms of the structure of derivatives for the Indian market. So if you look at interest rate derivatives, so again, you all understand what's meant by a derivative. It's basically a financial product that's derived from an underlying. And the underlying can be an interest rate, foreign currency, an equity, or more recently, credit. So the other thing you want to keep in mind is the distinction between an over-the-counter instrument, that's OTC, and exchange trade. All right, so, and the reason this is important is over-the-counter instruments are what are referred to as tailor-made or negotiated contracts. So the example would be a company that actually negotiates very specifically with another bank, let's say, on a type of derivative that it wants. So it's good in that it's tailor-made. The problem with OTC derivatives, and interestingly, the Indian regulatory structure has found a way around the problem, but generally speaking, the problem is a lack of transparency. In other words, the details of the transaction, the value at any point in time are not known because it's a negotiated contract. There is no market for the contract. As you'll see later on in India, they've found a way around that to some extent. All right, so an OTC instrument is over the counter. It's not regularly traded. The only way that you can trade it is to go back to the original party. So that's an over-the-counter instrument. On the other hand, no. So on the other hand, exchange-traded instruments are like stocks that trade on the NSE. Exchange traded because they're traded on a daily basis. The pricing is very efficient, and there's transparency. Everything that you want to know about the product is available to the individual. So the OTC instruments available in India. So start with the interest rate product. You've got forward rate agreements and interest rate swaps. Again, I'll define them as we get to them. Just understand that for right now in the Indian markets, interest rate swaps dominate forward rate agreements. Foreign currency, you can get forwards, swaps, or options. Another thing to keep in mind is when we talk about forwards versus futures, forwards are OTC instruments, and the equivalent on the exchange traded markets are called futures. Otherwise, they're very similar in every respect. Interesting thing with regard to equity. In India, there are no equity derivatives permitted in the OTC market. All right? The only equity derivatives that are permitted are all exchange traded. So you've got index futures, index options, and unique to India, you can actually buy futures on individual stocks. That's not common in other countries. And of course, stock options are common everywhere. And then finally, in the credit market, you've got what I call single name credit default swaps that are traded in India. All right, so this is an overview. Again, I would encourage you as we go through it. I'm not offended if you actually have a question and you stop me. All right, it's up to you. So if you have a question, if you raise your hand, I'll be more than happy to stop and clarify things. Okay, make sense? All right, so this is from a publication by the RBI, their annual report. I don't know if you can read it, but I have a graphic that will come up later on. But basically, this gives you an idea of the size of the different markets. All right, and again, I have been away from India long enough that lakhs and crores confuse me. So I just stick with millions and billions and trillions, okay? So all these numbers, and in fact, the RBI publishes everything in billions, all right? So to give you an example, if you take a look at index options, let's say 2012, 2013, all right? Index options, the value of the index options traded during that year was 208 trillion, all right? 298 trillion, that's 298 and 12 zeros. So you can convert that into crores, right? So, you know, if you look at it, on the equity side, the most commonly traded derivatives in India are index options. And as you'll see, the most commonly used index is the Nifty. They're actually available on 6 Indian indexes, but the Nifty is the most popular. Then on the currency side, it's interesting that forwards and swaps, which are OTC, are just about equal, a little bit over exchange-traded derivatives, futures and options. And interest rate derivatives, which are actually introduced fairly recently, have soared in use. It's a very efficient way to manage risk. All right, so again, you know, that's just to give you an idea, but a graphic, we go to the next one. All right, so a little bit of the regulatory structure in the Indian environment. So all over-the-counter derivatives, the regulations for them are determined by the RBI, Reserve Bank of India. So for any OTC instrument, the RBI sets the regulatory tone. If they're exchange traded, then the exchange that they traded on and SEBI, right, Securities and Exchange Board of India, are the ones that determine the regulations. So there's a demarcation in terms of who governs OTC versus exchange trading in the Indian environment. That third point is one of the interesting things that's unique to India. That is, OTC instruments, remember I said, are one of the problems is that they're not transparent. That between two individuals, you cannot find information about them. The Indian regulators, the RBI, has found a way around that, in that all OTC derivatives, all right, which in India are basically foreign exchange and interest rate, there are no equity derivatives, they have to be reported through the Clearing Corporation of India. Or even though it's OTC, they must be reported to the CCIL. What that means is, at the very least, you have an idea of the size of the derivatives, OTC derivatives, as an outsider. What it doesn't solve is the problem of valuing an OTC instrument. Right? In other words, in the stock market, you know the price of the stock at any time, right? Because it's a very liquid market, and if you want to check the price, you can go online and check the price. You cannot go online and check the value of an over-the-counter instrument, say a foreign exchange swap. You cannot. The only way you can do that is to actually sit and try and value it yourself, which is obviously not very efficient. So that's the problem you just can't get around. But the reporting aspect is actually very unique to the Indian market. All right, so let's get into some details about the various types of derivatives. All right, so with options, some of you I think had options classes. You've got basically two types. You've got call options and put options. All right, so a call option basically gives you the right to buy an asset at a fixed price, which is the exercise of the strike price, before a certain date. So again, what I'll do is I'll give the definitions, but we'll use an example. In my case, I think I use Randback's options to give you an idea of how they work. So that's a call option, and keep in mind that these instruments give you the right to do something. It's not an obligation. As you'll see later on when we talk about futures, futures represent an obligation, a contractual obligation. So a put is similar in the sense that it's now an instrument that gives you the right to sell an asset, stock, or currency, at a fixed price by some certain date. That's basically it. But there's some terminology and options that you should be comfortable with. All right, so you should be aware of the difference between the buyer of an option and the writer of an option. Most of us know, generally speaking, talk about the buyer of an option, but you should understand that there's another investor that actually created that option, who's called the writer. So you've got the buyer of the option and an investor that created the option, which is the writer. We talked about the strike or the exercise price. The option premium is the price that you pay on the option. Expiration date is obvious. Here's something that's a little funny or odd. Options are classified as either European or American. And it's got nothing to do with where they trade. I don't know why they came up with those terms. They could have come up with Indian and Chinese. Right? But anyway, so European and American. The difference being an American option can be exercised at any date before expiration. Right? Anytime you want, you can exercise the right to buy if you have a call, or the right to sell if you have a put. If it's a European option, or a European variety option, you can only exercise at expiration. That's a huge difference. Now in the US, all options generally tend to be American. You can exercise at any time. In India, all options are European. All right, so I'm not sure why, but that's basically the way. Again, I think it has a lot to do with the fact that the regulators are very concerned about risk. So one way you can mitigate risk is to get over the valuation problem and say you can only exercise at expiration. Otherwise, you have to use a valuation model, basically. All right, we already talked about the difference between listed and OTC options. All right, now a little bit about the structure of options in the US. So, I'm sorry, in India. So, you can buy options on stocks, but they're designated. You cannot buy them on every stock. So right now, there are 133 stocks listed on the NSE on which you can buy puts or calls. Only 133, of which Ranbaxy is going to be one of them. Index options, there are actually 6 indexes in which you can trade options, but the Nifty is the most widely used. And again, the other thing you want to keep in mind is that the NSE pretty much dominates the BSE relative to everything. All right? So if you look at the turnover of all derivatives, on the NSE it was almost 313 trillion, whereas on the BSE about 8 trillion. Huge difference. All right? So the BSE, for all intents and purposes, is almost non-existent relative to the NSE. All right, so this just shows you a graphic that indicates to you clearly that in India, index options are the most popular. All right, by 72% of the options traded are on indexes. And that just shows you the numbers relative to that graphic. With regard to currencies, exchange traded still dominate OTC, but they're very close, all right? So you can see that around 60% of currency derivatives are exchange traded, 40% over the counter. So these would be swaps and forward contracts. And again, these are just the numbers that relate to that graphic. So go ahead. Okay, so the thing now is how can you use options, right? So what I did is put together some numbers using Ranbaxy as the guinea pig, so to say. All right, so if you go to the first, so these are what are called profit profiles on Ranbaxy stock. Let me explain to you how these are basically calculated. All right, so Ranbaxy on December 18th traded options, call options that expired in January, so January 30th, 2014. At the time, this particular option had a strike price of 440, which means that if you bought the call, you were locking in to buy the call at 440 rupees. The price for that option was 28 rupees and 45 cents, 45 paise. So I think some of you had options in class, right? So that one thing, I think it's the same. In the US, when you buy options, the contract size is 100 shares. Same here? Yes.
The contract size is not. The contract size is not.
Is not fixed? Okay, so that, to be honest, so let's just assume that, in other words, in the US, if you want to buy options, let's say on Microsoft, all right, you call your broker up and say, I want to buy an option of Microsoft stock. In his mind, he understands you're talking about one contract. One contract is for 100 shares. All right, so when you say one, it's not on one share, it's one contract. I'm sure it must be the same in India as well, right? It's the same, right? Okay. So if you buy an option contract, it's for 100 shares of Ranbaxy. So this just shows it to you on a per share basis. All right, at the time, Ranbaxy was trading, the stock was trading at 438 rupees and 15 paise. So if you had purchased that option, as long as Ranbaxy stock stayed below, what is that? So 440 plus. Okay, so here we go. 440 plus 28.45, that's 468.45, right? So as long as Ranbaxy stock at the end of January was trading at above that, you would have the possibility of making a profit. So the option is actually going to make some money. If it traded below 468 rupees and 58 paise, you would basically be in a loss situation, right? So that's all of this below here. And the worst case scenario is if it traded below 440, you would basically lose what you paid to buy the option. That's the profile for a buyer. For the individual that wrote the call, this is the profile. As long as the Ranbaxy stock price stayed below 440, whatever you sold it for, the 28 rupees or so, you keep it, you pocket that. So obviously when you write an option, your hope is that the price doesn't go up. So these are called uncovered positions, that is, you don't own the stock. But what's interesting is how you can use these options to actually hedge risk. All right. So before that, you go to the next slide. These are the profiles for put options. So remember, put option gives you the right to sell puts at a certain price. You fix the price at which you can lock in. So in this case, you have purchased puts on Ranbaxy with a strike price of 440. In other words, you are looking to lock in the price at which you could sell puts. So let's backtrack a little bit. Why would you want to buy call options in general? What would be the reason for you to buy a call option?
I think that the prices would still go higher.
If you could go higher, right? So buying a put option is a reverse, right? If you think that the price is going to go down, one of the things you could do is to buy a put. Then you would benefit from actually a price going down. Obviously, the individual that sold the put is hoping that the price actually goes up. Because that way, if it goes up, whatever the premium he sold it for, he basically pockets it. All right, so here's how you can use these to hedge. So these are two different hedge strategies, all right? So the first one is a covered call. And in this situation, the assumption is that you already own Ranbaxy stock. So it's a covered call. But the question then is, how do you benefit from that using options? One way would be to sell or write options on Ranbaxy. All right? And if you do that, this is what your profit profile looks like. So then, so the way this is calculated is you own Ranbaxy stock and you sold covered call. You sold, in other words, you've sold someone else the right to buy Ranbaxy if the price goes up. So here's the thing you want to think about. When would you consider doing that? When would you consider writing a covered call? Would you do it if you thought the price was going to go up? If you thought Ranbaxy stock was going to go up, would you consider writing a covered call?
No.
And the reason is? Well, why would you, if you thought the price was going to go up, why would you cap your profit? That'd be silly, right? The reason you would write a covered call is if you thought Ranbaxy stock was going to stay flat. In other words, not do a lot. All right? So if it's going to be not very volatile, just stay flat, one way to pick up some extra money would be to write these calls. This is a more interesting hedge strategy. This is what's called a protective put. So again, in this case, you own Ranbaxy stock. All right? But what you're doing is you're buying puts at the same time. This is basically insurance. In other words, if you buy the right kind of put, you can limit your loss. Look at the, I don't know if you can see down. Can you see down all the way down? Okay, so as Ranbaxy stock goes down, your loss gets locked at a certain level. That's insurance, right? Now in this case, this was an expensive option, right? It was almost 30 rupees. So what you do, essentially doing is locking in your loss at around that 30 mark. But instead, if that's too much for you per share, you can buy an option that's a little cheaper. It will probably have a lower strike though. All right, so those are basically some simple hedges